All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today is July 24th, 2025. And the top story this morning, well, there's a couple. We got a three-way tie for the top story this morning. We got big earnings from Google, big earnings from Tesla, and United Health is under investigation once again. Let's take these one at a time. Google earnings, big beat. It's a fantastic quarter from Google. Really good. Most importantly, I think arguably the most important thing in Google's earnings, at least from the bullish case, is that search showed significant growth. There's been a lot of worries that AI is going to take away Google's search business, which is like their bread and butter. And well, that's not happening. Search showed some excellent numbers. We'll talk about what those numbers were today. That shows that some of those worries about AI taking away search was overblown. And when you think about it, maybe that's not the good news that the market is interpreting that. If AI is not eating away at search and Google's search business, then maybe that's because AI is not as good as everybody's saying it is. Well, geez, if only somebody had been shouting that from the highest mountaintop since the middle of 2023. But I digress. We also saw really good numbers from YouTube, cloud growth. Of course, that continues to be strong. That's Google renting out their GPUs, usually at a loss, to companies that lose money. You can see earlier comments about AI. Now, Google's amazing results were tempered somewhat when they surprised everybody by increasing their Capex forecast for this year. They announced they're going to increase it from $75 billion to $85 billion. That was unexpected, and the market initially didn't like it. Google traded a little bit lower shortly after that announcement. It ended up recovering that. It's up by a couple of percent this morning. But people are worried that they're just burning too much money on these investments in AI. And you can see it in their free cash flow. Google's free cash flow was down to just a little over $5 billion. 60% drop year over year in free cash flow. The company is spending almost every dollar they make on their investments in AI, which so far are not yielding any significant returns. And investors are worried about that. But you know what? That is good news for the hardware manufacturers, NVIDIA chief among them. If big tech is continuing this great game of Capex chicken, that means they're going to continue to put up those magnificent numbers. Also, we got big earnings from Tesla. It was a miss across the board for Tesla. Dreadful quarter for them. In particular, auto sales down 16% year over year. Not a big surprise there. People are throwing freaking Molotov cocktails at the things, and everybody's keying them in California, right, with Elon's political activities. Turns out when your customer base is predominantly climate-conscious liberals, backing a Republican for president and getting heavily involved in his administration isn't great for business. A shocking turn of events, I know. So here's the question. How is Tesla going to keep trading at a 200 multiple of earnings when their sales are in decline? If you're a growth company, aren't you supposed to have growth? Or if you're going to be valued as a growth company? And if you're not going to be valued as a growth company, if you're going to be valued as a value company, well, yikes, that value is a hell of a lot lower than it's currently at. Also, Tesla has other problems on the horizon. Electric vehicle tax credits are going away. Regulatory credits are going away, or at least the mandate that Tesla's competition buy carbon credits from them, these arbitrary magical commodities that are created out of thin air because climate. Those are going away as part of the big, beautiful bill. Ford and Chevy aren't going to be required to buy those things from Tesla. So what's Tesla's long-term growth horizons? I don't know, diners, rocket planes, robots, robo-taxis. Maybe these things are going to be big, maybe not. If they're not, Tesla's host. Also, free cash flow from Tesla, way down, 89% drop year over year for Tesla. Yikes, buddy. Yikes. Elon, you got your work cut out for you over there. It might be time to focus a little bit on your business ventures. And of course, the big one just breaking. It's a big drag on the Dow this morning. United Health confirming that they are under investigation by the Department of Justice for Medicare billing practices. We've had this story for a while. We talked about this one last summer. United Health was doing things like basically calling people up out of the blue, people in their Medicare Advantage plan, saying we want to send a healthcare provider to your house just to do a wellness check on you and, take your blood pressure, all that good stuff. They send a nurse practitioner to the house. They do a couple of arbitrary examinations. And then magically, these people have diabetes-induced cataracts. And in some cases, the patients didn't even know. But you know what? You can bill Medicare 60 to 80% more every year for insuring a patient with those diabetes-induced cataracts. And go figure, the diagnosis rate for Medicare Advantage patients with that particular ailment is through the roof. And every single ailment that triggers a higher payout from Medicare, well, Medicare Advantage patients at United Health tend to have significantly higher rate of diagnosis for that than the general population. In other words, United Health is lying about how sick their patients are so they can steal more money from the taxpayers, and the government is finally catching wind of it. And gee, we wonder why healthcare keeps getting so expensive and why government spending keeps getting so much worse. And then look at a chart of United Health stock. I'm beginning to think these two things might be related. We've also got a couple other things going on this morning. American Airlines reinstated their guidance and lowered it at the same time. We've got a boost to domestic travel being offset by declines in international travel. Almost certainly the trade war playing a role there. That stock is down this morning. Deutsche Bank is at a decade high this morning after posting a pretty impressive quarter. We saw the same thing with the American big banks here. All of that volatility in April was very lucrative for the big banks who made a ton of money on their fixed income trading as bonds went down and then right back up. We've got what's going on here? Oh, an interesting story about European dollar bonds this morning. My moderator, Mish, caught this one. You're not going to want to miss one. It's going to be towards the end of the show. But in my opinion, this is uber bullish for gold, this article about these dollar-denominated European bonds. We got jobless claims are out again this morning. And we've got President Trump is touring the Federal Reserve, probably so he can just look around, point to something, make some kind of soundbite, and use that to try to gin up support for his efforts to fire Jerome Powell. And look, I've had a couple of people chime in on the comments here about the Fed should be investigated and Powell should be fired. All right. Yep, I agree with all of those things. I am not a president of the Fed fan club. I hate the Fed. I hate what they do. But here's the problem. President Trump isn't trying to fix the Fed. President Trump is trying to make the problems at the Fed worse to inflate his bubble. That's the problem with what President Trump is doing at the Fed. People need to stop letting President Trump tap into the end the Fed energy, because what he's going to do with that is make things worse. He's going to print more money. He's going to lower more interest rates. He's going to further inflate these bubbles, which is responsible for the big gap in wealth in this country. So stop letting him get away with it. He's not going to fix it. He's just going to turn the money printer on sooner. We got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's going on in markets here this morning. And hey, don't forget that like button and that subscribe button for the YouTube algorithm, because we do this every day. So come back and have your coffee with the melon heads as we go through markets. And right now, the S&P 500 is just barely positive, up 2 points or 0.03% in the green. The Dow, meanwhile, is down 300 points, 0.2%, almost all of that coming in the immediate aftermath of the story breaking about United Health being under investigation for the DOJ. UNH is the single largest component of the Dow index. And we've got the NASDAQ is actually positive here, up 40 points or 0.17%. Google probably buoying the NASDAQ this morning. Looking over at the U.S. dollar, it's up about 15 basis points here, 97.37. A little bit of volatility in the last couple of minutes. Not sure what's going on there, but a slightly stronger dollar this morning. And looking over at the bond market here, we've got largely higher yields. The 30-year Treasury is up by 3 points and change, 4.983% for the 30-year. The 10 years at 4.438. That's up by almost 5 basis points this morning. The 2-year at 3.927, up 4 points and change. And the 1 month is at 4.289, down a fraction of 1 point. Looking over at commodities, we got a little bit of red this morning. Markets are generally risk on at this point, so I'm not surprised to see metals down a little bit here. Spot gold, $3,357. That's off by about $30 or 0.88%. Spot silver is at $38.88. That's down about 37 cents or about 1%. But you know what? I still like the shiny. You guys may have heard that by now. Copper, meanwhile, is a little bit higher, 0.3% to the upside. Platinum's down 1%. Palladium is down 2.3%. And oil catching a bid here, 1.25% higher at $66.05 for September WTI futures. Looking over at Bitcoin, we're pretty much right where we were yesterday morning, $118,720 as priced on Coinbase, still trading within this band that we have seen since that high on Monday the 14th. All right, let's talk about the big one this morning. Google earnings roundly beat estimates. Growing Capex remains an issue, and that pretty much summarizes it pretty well. It was a fantastic quarter, but that Capex is the rub there. Google parent Alphabet beat expectations for its second quarter earnings results Wednesday afternoon. The stock initially fell in after-hours trading before climbing after the company held its post-earnings call with investors. Earnings per share were up to $2.31. That's ahead of the Wall Street consensus of $2.18 and up from $1.89 last year. Revenue for the quarter reached $96.4 billion. That's above expectations for $94 billion and up 14% on the year. Leading the charge was Google Cloud, with sales up to $13.6 billion in the quarter. That's ahead of the $13.1 billion the market was expecting and up 32% year over year. The number of cloud deals over $250 million doubled this year. That's Google renting their data centers and their GPUs to the AI companies that all lose money. Most of the money they're getting for rentals is actually in the form of data center credits being redeemed. We've seen this one over and over again. Advertising revenue was strong in search and YouTube. All told, ad sales were up 10% from 2024 and ahead of Wall Street expectations. That's kind of an understatement there. The fact that search revenue was up in this environment, the market has been very worried that AI is going to cannibalize all of Google's search revenue. That's just not happening. Yes, that's good because that means the search business is strong, but then you got to wonder, well, then what are they spending all that money on for AI? If it's not taking away business from search, then what is it actually doing? I guess more to come on that in the future. YouTube continues to drive advertising sales up 13%. Meanwhile, subscriptions are a growing portion of revenue. Really good numbers from Google all around, or from Alphabet. Now, for some investors, the excellent results might have been overshadowed by a significant rise in Alphabet's projected Capex for 2025 from $75 billion, just reaffirmed 3 months ago, up to $85 billion. With about $40 billion invested in the first half of the year, that leaves another $45 billion remaining in 2025. Now, the reason why this is such a concern, you can see this in this chart showing the last few quarters of Google's free cash flow. And you can see here just in the last few quarters, the fourth quarter, $24.8 billion of free cash flow. In the first quarter, $18.9 billion free cash flow. And then in this most recent quarter, $5.3 billion in free cash flow, down 61% year over year. Yes, Google is making money, but all of the money Google is making, they're turning around and pumping it right into their data centers. And it kind of makes you wonder, are they going to turn a profit on these data centers? And if you guys are confused about, hey, what might Google's strategy be for this massive CapEx? Well, I think the underpants gnomes have summarized it best. Phase 1, buy GPUs. Phase 2, phase 3, profit. By the way, this segment is brought to you by Tweaks Coffee. At some point, they're going to hopefully make a profit. Hopefully before hundreds of billions of dollars in depreciation, because all these GPUs that they're buying, they're now about a year and a half old, and they continue to get older. That's how time works. And as those things get older, they're worth less money, which means your PPE, plants, process equipment, or whatever it is, you have to mark down the value in those assets, and that comes out of your earnings. And so if those assets don't start generating a return, the depreciation is going to eat them alive. Well, good luck. That's coming some point in the next 2 or 3 years. But for now, Alphabet stock up 3.4%. Let's refresh this one because it's been a volatile morning. Yep, 3.4% higher, $198.05 for Alphabet. Looking pretty good here this morning. Now, contrast that with Tesla. Tesla shares dropped 6% in pre-market trading after auto sales plunge again. It was a pretty rough quarter for Elon. Tesla shares fell 6% in pre-market trading on Thursday after the company reported a second straight quarter of declining automotive sales. Elon Musk's electric car maker reported a top and bottom line miss on second quarter results, noting that automotive revenue fell 16% year over year to $16.7 billion. Tesla is, remember guys, despite Optimus Prime, despite robo-taxis, Tesla is a car company. and their car sales are declining. And a car company with declining sales probably shouldn't have a 200 multiple. All right. It probably shouldn't be trading at 200 times earnings, but I digress. On an earnings call, Musk said Tesla probably could have a few rough quarters, you think, ahead as a result of the expiration of federal electric vehicle tax credits. I'm not saying that we will, but we could, Musk said. Tesla has been facing rising competition in key markets like China and Europe, especially from lower-cost Chinese electric vehicle players. Yeah, that and Elon's politics are causing a problem for their electric vehicle sales. Now, I want to send a shout-out to my friend, the Coastal Journal on X, who put this one out yesterday. Tesla earnings say you are PE ratio of 207. Well, okay, a PE ratio of 200 is justified if you're growing. Let's see what that growth looks like. Free cash flow down 89% year over year. Yikes. You know, you can play all kind of games with accounting. You can, prematurely recognize revenue. You can mark up asset prices, but you can't fake money in the bank. Free cash flow of negative 89%. That is a whole bunch of yikes right there. Receivables up 33%. That's a big red flag. All right. When you're seeing your free cash flow plunge and your receivables is rising, that can be an indicator of premature revenue recognition, accounting gimmicks being used to inflate earnings. Pay close attention to those receivables. Inventory up 33%. EV tax credits ending soon. Bitcoin gains propping up EPS. And something I would add here, the fact that those regulatory credits, $439 million worth of regulatory credits in this last quarter for Tesla, those are going away thanks to the big, beautiful bill, which says that the other automakers are no longer required to buy carbon credits, which Tesla sells a lot of carbon credits because, I don't know why, because it's just an imaginary commodity that the climate people made up. Good luck with that. Guys, this was a really bad quarter for Tesla. There's no ifs, ands, or buts around it. Tesla stock down 6% here, $312.63, off by $20. And again, you're trading at almost 200 times earnings. If your sales are in decline, you just can't do that. And if Tesla was going to be valued like any other car company, yikes. We're talking double digits, not triple digits, probably low double digits for Tesla if that ever happens. Also big this morning, United Health says it's facing DOJ investigation over Medicare billing practices. We've seen a few headlines like this year, guys. Things just keep getting worse for UNH. United Health Group revealed Thursday it's facing a Justice Department investigation over its Medicare billing practices. It comes after the Wall Street Journal reported in May that the DOJ is conducting a criminal investigation into the healthcare giant over possible Medicare fraud. In response at the time, the company said it stands by the integrity of our Medicare Advantage program. A surprising statement from the company. In July, the Journal also reported that the DOJ interviewed several doctors about United Health's practices and whether they felt pressured to submit claims for certain conditions that bolstered payments from the Medicare Advantage program to the company. That marked the second time this year that the insurer's Medicare Advantage business has come under federal scrutiny. The Journal also reported in February that the DOJ is conducting a civil investigation into whether the company inflated diagnoses to trigger extra payments to its Medicare Advantage plans. Yikes, the nation's biggest insurer committing widespread fraud. That stock. Let's refresh this one. It was down about 4.5%. Let's see, now down 3%, $283.47. That's taken a big chunk out of the Dow this morning. And look, guys, if you want to wonder why the government spending keeps going up so much, like Medicare spending, why healthcare keeps getting so much more expensive, take a look at this long-term chart of United Health going all the way back to the 1990s. Gee, you think maybe some of that money being pumped into healthcare by both governments and our own personal pockets might be overly inflating United Healthcare stock? You think maybe that's what's going on here? And look at, of course, taking the elevator down here ever since the CEO assassination and the multiple announcements of DOJ investigations. United Health stock has given up almost, what's that, about 50, 60%? It's been a rough couple of months for UNH, and they're not out of the woods yet. Also going on this morning, American Air falls after raising doubts about U.S. travel rebound. American Airlines Group scaled back its earnings outlook amid a persistent slump in consumer demand, casting doubt on the recovery in U.S. travel and sending its shares tumbling. Results for 2025 range from an adjusted loss of 20 cents a share to a profit of as much as 80 cents, American said Thursday in a statement, with a midpoint of 30 cents per share in earnings. That compares with a 72-cent annual profit expected by analysts. American had withdrew earlier annual guidance in April. So, yeah, they're putting their guidance back up, but they're lowering it substantially. Not good for American. Shares dropped as much as 8% in pre-market trading. The stock had declined 27% this year through Wednesday. The carrier's outlook for the rest of the year diverged from new, more bullish forecasts from United Airlines and Delta as business and consumers resume travel, shrugging off President Trump's varying tariff threats and other risks such as inflation and disruptions at some airports. American said it could hit the top end of its forecast if the domestic market continues to strengthen. So what's not being said here is international travel is killing American. Domestic looks pretty good. Some of the other airlines have posted pretty good results, but for whatever reason, American is particularly vulnerable to this. I'm sure that international travel decline is related to the trade war. American stock currently down 6.3%. Let's get a good mark here. 6.4%, almost 6.5%, $11.87 a share for American. Rough morning there. Meanwhile, Deutsche Bank hit a decade high as sowing strategy pays off. Sowing being the CEO of the company. Look, I don't think this is anything to do with the CEO strategy. I think this is just April volatility here. We saw this with virtually every bank. Deutsche Bank shares rose to the highest in a decade after reporting better than expected trading results as Germany's largest bank continues its recovery under CEO Christian Sewing. Suing. I don't know. Who's he suing? I don't know. Income from trading bonds and currencies rose 11% to $2.28 billion from a year earlier, beating analyst estimates for revenue of 2.2 billion euros. And mirroring a strong performance across Wall Street, the shares rose as much as 8.4% to the highest since August of 2015. So, look, income from trading bonds, guys, that's just your April volatility. That's not a CEO strategy. That's not, our plan to rebuild the company is succeeding. The market freaked out in April because of the trade war, and then Trump tacoed and everything recovered, and the people who take fees for trading made a ton of money off of that volatility. It's not too shocking. It's nobody's strategy. It's just what happened. Look, Deutsche Bank up 6.4% in pre-market trading. Shares looking pretty good. If we zoom out here, showing all results, okay, yeah, that's about the highest we've seen since 2015. But still nowhere near what Deutsche Bank was trading at back in the pre-GFC days. Now, sticking with this European bank theme, I saw this article. My moderator, Mish, found this one. Thank you, Mish, for finding this. This is pretty interesting this morning. Europe's top dollar bonds eclipse treasuries in safe haven race. This is pretty crazy. I was very surprised to see this one, and I think this is very bullish for gold. Now, bear with me. I'll tell you why. Dollar bonds from some of Europe's biggest public sector issuers are now trading at yields below comparable U.S. government debt, an unusual turn that underscores the diminishing appeal of treasuries. Remember, guys, the yields are inversely proportional to the price of the bonds, which means dollar debt from European government-backed banks is worth more than dollar debt from the United States government. That is striking. That is a huge development, in my opinion. The rate on some bonds issued by European Investment Bank and Germany's state-owned lender KfW have dipped below comparable U.S. government debt in recent sessions. The European securities have outperformed since April, when U.S. President Donald Trump's tariff announcements roiled global markets and fanned a debate about U.S. Treasury's safe haven status. That's a big one there, too. U.S. Treasury's no longer functioning in a pure capacity as a safe haven status. The main drivers, in our view, have been market concerns about the U.S. economic and inflation outlook, uncertainty about U.S. tariffs, and rising public debt levels in the U.S., said Frank Will, HSBC's global head of SSA and covered bond research. So, look, the U.S. lost their last AAA credit rating. Moody's, Fitch, and S&P, they've all now downgraded the U.S. to AA or whatever. It was below AAA. Now these European government-backed banks, for whatever reason, have a higher credit rating than the U.S. government. Forget that for a second. The fact is traders prefer dollar debt issued by European banks to the United States government. That is huge. That means the U.S. Treasuries are no longer functioning as a safe haven asset. And that's why I think that is so uber bullish for gold. Because if U.S. Treasuries ain't a safe haven, yeah, sure, you could go to European debt. If you think European debt is any better, it's not. Or you could go to gold, which definitely is better. And I think if you're looking for a reason why gold has done so well since April, guys, look no further. This is it. All right. The U.S. Treasury bond is losing its luster as a place to go during a storm. And gold is the chief beneficiary of that. And I remember even saying during April, I was shocked at Bitcoin's performance during that big sell-off in the bond market. Yeah, Bitcoin was going down, but it was holding its own. There were things were up in motion. The whole global regime was changing. And this story about European bonds trading at a higher price and a lower yield than U.S. government debt is just another facet to that story. Safe havens are changing around the world. Guys, there's just not enough gold for what's coming. I keep saying that. Got to own some shiny, everybody. All right, let's talk about jobless claims. We got that data, and it is more of the same. Initial jobless claims continuing to fall, 217,000 for the week ended July 19th. That is down from 221,000 the prior week. Look, guys, there are headlines about layoffs, especially in big tech. And, the headlines, they do get a lot of attention, but layoffs are in decline. All right, forget the headlines and the anecdata for a second. Look at the numbers. Fewer people are losing their jobs. So if you're worried about mass layoffs, now's not really the time for that worry. And look, I'm typically a pretty negative guy. We don't really do optimism here. You may have noticed. But this is an optimistic trend. The rate of people losing their jobs has been falling steadily for months. Now, that being said, people are still losing their jobs. We are still getting initial unemployment claims, and those people cannot find new jobs. That has also been a steady phenomenon, and that is less encouraging. Continuing jobless claims, 1,900 and what's the actual number? 1,955,000 for the week ending July 12th. That is up from 1,951,000 the prior week. So a slight uptick in continuing claims despite the downtick in initial claims. Right? So it is a lousy job market. Maybe people aren't getting laid off en masse, but those who do get laid off can't find another job. That's an important thing here. So no, it's not a strong labor market, but it's also not the catastrophe that some are making it out to be. Also, we've got President Trump to visit the Federal Reserve, escalating the campaign against Chair Powell. Look, guys, we've talked about this a lot. President Trump, he's going to go tour the Federal Reserve. He's going to look around at the construction and the refurbishment. He's going to say, that's terrible. That's terrible. We shouldn't be spending money on this. We shouldn't be doing that. And I don't disagree with any of that. But President Trump's motivations here are disingenuous because he is not trying to stop the waste and the abuse at the Fed. He's trying to get rid of Jerome Powell so he can put a yes man in charge at the Fed who's going to lower rates and print money to inflate his bubble. That's what President Trump wants to do. And everybody keeps coming in the comments and saying, Jack, you shouldn't be defending the Fed. I'm not defending the Fed. All right. I'm not doing that. You want to get rid of the Fed? Fire them all. Destroy the organization. I'll help you tear down that building. Give me a hammer. I'll get to work today. That's not what they're going to do, though. They're going to make it worse. Don't let him tap into your anti-Fed energy in order to make the problems at the Fed worse. You're being played if you think this is a good idea. And speaking of being played, we got to talk about this one. All right. We saved it for the end here. Justice Department told Trump in May that his name is among many in the Epstein files. Gee, do you think maybe, just maybe, this has something to do with the fact that all of a sudden the Epstein client list doesn't exist? You think maybe that might have something to do with it? I'm just throwing it out there. Yeah, about that. Oh, this is awkward. Look, guys, we've now had both parties have been in possession of this information and both parties have done nothing. They're saying in this article that hundreds of names were in this list. Hundreds, all right? Not dozens, not a few, not one Republican, one Democrat, or two Republicans, three Democrats. No, hundreds of names. And President Trump was among them. Now, they're saying there's no evidence to suggest any non-charged third parties could be prosecuted. All right. That's what they're saying. All right. They're saying, oh, yeah, Attorney General Bondi looked at this information, and there's nothing that says we could prosecute anybody. And then in the same sentence, they're saying we can't release this information because it contains child sex abuse material. Okay, if you can't release the information because there's abusive material in there, that would also mean that there are pictures and video of people doing the abusing. In other words, there are abusers, and those people have faces, and those people have names. And therefore, you must be lying when you say there's nothing to suggest anybody who hasn't been charged could be charged. These people are talking out of both sides of their mouths. All right, JP Morgan knows who it is because JP Morgan had to pay a $200 million fine to the Department of Justice to settle the charges that they were allowing Epstein's finances. All right, which means we know who was paying Jeffrey Epstein because we have accounts that money came from before it went to Jeffrey Epstein accounts, and we know there are names attached to those accounts. We know who these people are, and they won't tell us. Don't let them get away with it. Don't let them get away with it. Just because you voted for the guy, which, by the way, I did 3 times, doesn't make this any less heinous. All right? Release the information, and if there's proof that he committed these acts, throw his ass in jail. But I digress. All right. Guys, I just want to say thank you so much for having your coffee with the Melonheads this morning. I appreciate that. We got a little uncomfortable at the end there, but sometimes uncomfortable things need to be said. But I just want to say thank you so much, everybody, for joining us this morning. Thank you to my Patreon supporters for everything you guys do for the channel. I got links down below should you feel so inclined. Don't forget that like button and the subscribe button on the way out. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.